Good afternoon from New York. It's 2:01 p.m. on Thursday, March 26, 2026. Welcome to the Lynx Data Insight Market Briefing. This analysis is AI generated by Lynx Data Insight and is for informational purposes only. It does not constitute financial advice. Markets are open and selling off hard as we speak. Let's get right into it.
And the tape tells the story immediately. The S&P 500 is at 6,496, down 1.45%. The Nasdaq is taking it worse, down nearly 2% at 21,497. The Dow is holding up relatively better at 45,982, off just under 1%. The Russell 2000 is at 2502, down 1.36%. The VIX is at 27.93, firmly in elevated territory. The 10-year Treasury yield is pushed to 4.41%, and the 2-year is at 3.62, giving us a 79 basis point positive spread. This is a classic geopolitical risk-off session. Oil surging, equity selling, yields climbing on inflation fears rather than growth optimism. The driver is singular and overwhelming: the Iran war, the Strait of Hormuz, and the complete repricing of global energy supply.
So walk us through the primary catalyst, because there are multiple developments today that seem contradictory. Iran allegedly let 10 tankers through the strait as a gesture, but then they also rejected the ceasefire. Which signal should investors trust?
Neither, fully. That's the problem. Here's the sequence. President Trump confirmed at a cabinet meeting today that Iran allowed 10 oil tankers through the Strait of Hormuz earlier this week as what he called a present to the United States. On its face, that's a de-escalation signal. But then Iranian state media reported that Tehran rejected the U.S. 15-point ceasefire offer and countered with its own 5-point plan that would give Iran sovereignty over the strait. And to complicate things further, Israel confirmed it killed Iran's naval commander Ali Reza Tangsiri, the man who was overseeing the Hormuz blockade, in a strike at Bandar Abbas. So you have three headlines pulling in three directions: a goodwill gesture, a rejected peace deal, and a targeted assassination that could either degrade Iran's ability to block shipping or provoke further retaliation. The market is resolving this ambiguity the way it should, by pricing in continued supply disruption. Brent crude is near $107 a barrel, up almost 5% on the day. West Texas Intermediate is at $95. According to CNBC, the French finance minister said 30 to 40% of Gulf refining capacity is damaged or destroyed, and 17% of Qatari gas production capacity is gone, with restoration timelines measured in years.
That refining capacity number is striking. That's not just a flow disruption, that's structural damage to the energy supply chain.
Exactly, and that's what separates this from a typical geopolitical flare-up. Even if the strait reopened tomorrow, you've lost physical infrastructure. The G7 ministers meeting in France today are calling this a catastrophe for the global economy, and Germany's defense minister explicitly said Europe was not consulted and this is not their war. The diplomatic isolation of the U.S. position is itself a risk factor because it means there's no multilateral pressure mechanism to force a resolution. The U.S. is simultaneously negotiating via Pakistan, threatening to seize Karg Island with ground forces, and celebrating targeted killings. That is not a coherent off-ramp. It's a set of escalatory options disguised as diplomacy.
And all of this is feeding directly into the cross-asset picture. What are you seeing across bonds, currencies, and gold?
The causal chain is textbook but intensifying. Oil above $100 is pushing inflation expectations sharply higher, which is pulling the 10-year yield up to 4.41%. That yield move is crushing rate-sensitive equities. Look at the Nasdaq down 2%, with semiconductor names like Advanced Micro Devices, ticker AMD, down 6%, and Lam Research, ticker LRCX, down over 6% as well. Meanwhile, gasoline is at $3.98 a gallon nationally, up 33% in a month according to AAA. Goldman Sachs upgraded its March through April Brent forecast to an average of $110 a barrel, which the Stanford Institute for Economic Policy Research projects if crude stays at that level, retail gas could peak at $4.36 a gallon in May, which they estimate would wipe out most or all of the larger tax refunds the average household is receiving this spring. So the chain runs Hormuz blockade pushes Brent above $107, which spikes gasoline to nearly $4, which erodes consumer purchasing power by $740 per household annually, according to Goldman, which pressures discretionary spending and restaurant margins, which is why consumer cyclical stocks are among the weakest sectors, with only 21% of names above their 50-day moving average.
That brings us to the question every investor wants answered. What does this mean for the Fed?
This is the Fed's nightmare scenario, a supply-side inflation shock hitting while the economy is already under pressure from geopolitical uncertainty and a partial government shutdown at DHS. What was a rate cut narrative as recently as January has been completely disrupted. The Fed funds proxy sits at 3.62%, and the market had been pricing in 2 to 3 cuts this year. That expectation is now shifting rapidly toward a prolonged hold, and if oil-driven inflation persists through the second quarter, we could see the conversation pivot toward the possibility of tightening. Powell is under extraordinary political pressure. Trump called him a moron again today, and the criminal investigation subpoenas were just defended by Fed lawyers in court. But the data is the data. With headline inflation poised to re-accelerate on energy alone, and with the 10-year at 4.41%, the Fed cannot credibly signal cuts while Brent is above $100. My read, the June meeting is a definitive hold, July is a hold, and if oil stays at these levels through September, the first cut gets pushed into 2027. The 2-year yield at 3.62% tells you the bond market still expects the next move to eventually be a cut, but the timeline has stretched dramatically.
So, who were the clear winners and losers from today?
Let me break this down by cyclical and structural layers. Cyclical winners, first, energy producers. Upstream oil and gas names benefit directly from crude above $100. Valero, ticker VLO, is up 4.7% today as a refiner benefiting from elevated crack spreads, particularly since non-Gulf refining capacity is now at a premium. Second, defense contractors. General Dynamics closed at $352.50 yesterday, up nearly 2%, and with the U.S. deploying additional troops and Israel conducting targeted strikes, defense spending is accelerating. Third, gold miners. Newmont Corporation has been outperforming with 2.5% gain yesterday, as gold benefits from both geopolitical hedging and inflation protection. Structural winners, energy infrastructure companies positioned for the long rebuild of damaged Gulf capacity, which France's finance minister said will take 3 years. Also, domestic semiconductor manufacturers benefiting from Apple's expanded American manufacturing program, the $400 million investment through 2030 announced today, supports names like Global Foundries and Texas Instruments in the reshoring theme. And cybersecurity. Palo Alto Networks, ticker PANW, up 3% today, and Fortinet, ticker FORTNY, up nearly 3% as well, as geopolitical conflict and the surge in AI-driven bot traffic reported by Human Security today are both tailwinds for security spending. Cyclical losers, airlines, are the most obvious. United Airlines just reached a $740 million signing bonus deal with flight attendants, while simultaneously facing jet fuel costs that have surged 106% in a month, according to IATA. United's CEO said oil could reach $175, and the company's annual fuel bill could hit $11 billion. They're cutting unprofitable routes over the next 2 quarters. Broader tech is also a cyclical loser. The Nasdaq's 2% decline reflects growth multiples compressing as the 10-year pushes higher. And consumer discretionary is pressured as gasoline costs consume household budgets. Structural losers, Meta, ticker META, down 6.3% today, which is the steepest single-day decline since October. This is a convergence of headwinds, the $375 million verdict in New Mexico, the $6 million liability ruling in Los Angeles, hundreds of layoffs announced Wednesday, and $135 billion in planned capex against AI models that are behind Google, OpenAI, and Anthropic. That is a structurally deteriorating competitive position. Also, rate-sensitive real estate. With the 10-year at 4.41%, only 18% of real estate stocks are above their 50-day moving average, the lowest of any sector. And airlines face structural headwinds beyond the cycle if the strait remains contested for quarters, not weeks.
I want to flag something on airlines. You listed them as cyclical losers, but if there's a ceasefire and oil drops, aren't they a snapback trade?
They are, and that's an important distinction.
Airlines are near-term losers from $107 Brent, but they become tactical winners the moment a credible ceasefire materializes. The issue is that even in a rapid resolution scenario, the structural damage to Gulf refining capacity means jet fuel doesn't snap back to $60 levels. It normalizes somewhere higher. So the snapback trade works for a few weeks, but medium-term margin pressure persists. The United labor deal, which adds meaningful cost, makes the margin math even harder on the other side.
Let's talk about what's happening at the corporate level. Meta's collapse today is hard to ignore.
Meta is the convergence trade in the worst possible sense. You have legal liability risk that is potentially precedent-setting. Senator Durbin is comparing social media to big tobacco and calling for the end of Section 230. You have an AI strategy that a Harvard law lecturer called a watershed event in public trust. You have $135 billion in CapEx plans with no clear AI moat. And you have the stock already down nearly 5% over the past year, while Alphabet is up over 70%. The 6% single-day move today tells you institutional holders are reassessing the risk-reward. This connects directly to the macro story. In a rising-rate, risk-off environment, you do not want to own the mega-cap with the weakest competitive position and the highest cost structure. The market is doing exactly what it should, differentiating within big tech. Apple, by contrast, is actually up slightly today on the back of its manufacturing expansion announcement, absorbing $3.3 billion in tariff costs without raising prices. That's a company managing through the storm. Meta is being managed by the storm.
What's the risk case investors should stress test here?
Base case, Iran and the U.S. reach a framework agreement through Pakistani intermediaries over the next 2 to 4 weeks. The killing of Tangsiri degrades Iran's naval blockade capability. Oil gradually retreats to $85 to $90 per barrel by June. The 10-year yield settles around 4.2%. The S&P 500 finds support near 6,300, then grinds back towards 6,700 by end of second quarter. The Fed holds in June and July, with the first cut pushed to December at the earliest. That's the base case, and I'd assign it roughly 55% probability. Risk case, negotiations collapse. Iran retaliates for Tangsiri's killing with expanded strikes on shipping and Gulf energy infrastructure. Brent spikes to $130 to $140 per barrel. Gasoline hits $5 a gallon in the U.S. The 10-year yield surges past 4.7% as break-evens explode. The S&P 500 corrects 10 to 15% from current levels, which puts it in the 5,500 to 5,800 range. The Fed is forced into an emergency communication signaling that rate cuts are off the table for all of 2026, and consumer confidence craters heading into midterm elections. In that scenario, airlines lose another 20 to 25%. Consumer discretionary names get cut in half from their highs, and even energy producers eventually get hit as demand destruction kicks in. I'd assign this risk case about 25%. It's not the tail, it's the fat part of the left tail.
Given those scenarios, how should portfolios be positioned right now?
Highest conviction, energy producers. Immediately increase allocation over the next 2 to 4 weeks. The supply-constrained environment is durable even in the base case, and the risk case only amplifies returns here. Names like Valero for refining exposure and SLB for oil field services both have momentum and fundamental support. Secondary conviction, defense and cybersecurity, maintain and gradually increase structurally. General Dynamics, Palo Alto Networks, and Fortinet all benefit from the geopolitical regime shift and the AI security demand cycle. These are not just Iran trades, they're multi-year allocation themes. Tactical hedge, short-duration treasury bonds. With the 2-year at 3.62%, you're getting paid to park capital while maintaining optionality. This hedges the risk case without sacrificing significant upside. Gold exposure as a supplementary hedge is also warranted. Newmont offers equity leverage to the gold price with a reasonable cost structure.
core structural allocation, domestic semiconductor and AI infrastructure beneficiaries. Apple's manufacturing program expansion and the TSMC Arizona fab build-out are creating a multi-year capex cycle that is resilient to both the oil shock and tariff uncertainty, especially after the Supreme Court's ruling on tariffs limited executive authority. Avoid Meta and rate-sensitive consumer discretionary. Meta's legal, competitive, and cost headwinds are intensifying simultaneously. Consumer discretionary faces the double squeeze of rising gasoline costs and elevated borrowing rates. Real estate investment trusts outside of select apartment names should be underweighted with the 10-year at these levels.
What does it all fit together?
When you step back, this is really about a single variable, the Strait of Hormuz, repricing the entire global asset allocation framework. The blockade is pushing oil above $100, which is reigniting inflation expectations, which is forcing the Fed into a prolonged hold, which is compressing equity multiples across anything that needs low rates to justify its valuation. Meanwhile, the physical destruction of Gulf energy infrastructure means even a peace deal doesn't fully reverse the supply shock. The market is correctly differentiating, rewarding companies with real assets, real cash flow, and strategic positioning, energy producers, defense, cybersecurity, while punishing overvalued, high-cost business models like Meta. The 79 basis point positive yield curve spread tells you the bond market still expects eventual easing, but the path there just got longer and rockier. Every portfolio decision right now should be filtered through one question. Does this position benefit or suffer if oil stays above $100 for the next 2 quarters?
Give us 3 takeaways to close.
1. The risk. Iran's rejection of the ceasefire and the killing of its naval commander create a genuine escalation pathway. If Brent reaches $130 to $140 per barrel, we're looking at a 10 to 15% equity correction, and rate cuts are off the table through year-end. Monitor Hormuz shipping data daily. It's the single most important real-time indicator right now. 2. The market insight. The divergence within megacap tech is now the widest in years. Alphabet up 70% on the year versus Meta down 5%. This isn't noise. It's the market telling you that AI competitive positioning and capital discipline matter more than ever in a supply-constrained, rate-elevated environment. 3. The positioning idea. Energy producers and refiners are the highest conviction allocation today. The supply damage is structural, the demand is inelastic in the near term, and even the base case keeps crude elevated for months. Valero's 4.7% move today is not the end of the trade, it's the middle of it.